Advanced Financial Accounting. In this presentation, we're going to work through a consolidation problem where we have a parent-subsidiary relationship, the parent owning 100% of the subsidiary. We'll also be dealing with a situation where the fair value or depreciable assets are different than the book value at the point of purchase, which we'll have to account for within our consolidation process, and we'll have intercompany transactions we will be dealing with as well. We're going to be performing the consolidation after 1 year after the point of purchase. So in other words, we can think about the purchase taking place at the beginning of the year in January. We then doing the consolidation at the end of that year. Get ready to account with Advanced Financial Accounting. Here we have our information where we have P, which is going to be the parent company, purchased 100% of S, the subsidiary company, on January 1st. We're going to say 2000X5, so beginning of the year in essence. We're going to have our data, which we will be using for the consolidation as of the end of the year, including the trial balance for P and S as seen here to the right. So once again, we know that the purchase took place beginning of the year. It's been 1 year later. And now we have our data for consolidation as of the end of that year. We have goodwill. Now this is going to be a little bit different than the normal type of calculation we have. Normally, we would think that we would be calculating goodwill to see what goodwill is, to see whether there was goodwill in the transaction. But many book problems will reverse things around. So we're going to be giving then the goodwill at this point in time. We want to use the same kind of calculation to figure it out. And I would kind of think about this similar to a cost of goods sold type of calculation. So whenever you'll recall, cost of goods sold formula, you could be solving for any kind of number within the cost of goods sold calculation. You probably don't want to remember multiple different formulas for each, you just want to use the algebra and use the same formula and then plug in the unknown. So we'll talk a little bit about that calculation for the $24,000 of the goodwill. The life of the property, plants, and equipment, we're going to say is 11 years, which will be useful because there's going to be a difference between the building fair value and book value we will have to account for. SOP 25,000, in other words, intercompany transactions we'll have to be dealing with, meaning the accounts receivable for P shows that S owes P money, and the accounts payable, which for S, would show that they owe money to P, that we'll have to reverse out intercompany transactions. And then we're going to say that the goodwill resulted from a difference in fair value and book value of depreciable assets. So in other words, normally, if we were to do the consolidation, we would have the financial statement for S at the point in time that the purchase took place. We would have the assets minus the liabilities that would give us the equity. That would be the book value of S at that point in time. Not this one, because this is as of the end of the year. We would have to take that basically book value at the beginning of the year, and we'll talk about how to do that with these numbers in a second. Then we would revalue anything up top, including in this case the property, plant, and equipment. Once revalued, we would compare that number to the amount that was paid to see if there was anything on the books that wasn't accounted for, that being goodwill. In other words, the ending number of our calculation would be goodwill in a similar fashion as cost of goods sold being the ending number of our calculation with regards to the calculation of cost of goods sold. However, now we're giving kind of odd information, somewhat odd in that we know goodwill, but we don't know the difference in the building and machinery. So we can use the same formula to back into it. Not something we would typically see in practice, because we would probably have that number in practice, but in a book problem, common type of scenario. So that's the first thing we're going to do after we first just sum this across. So here's P's numbers, here's S's numbers. This is as of the end of the year. 1 year later, if we add them up, there's our consolidation information. Now we want to be considering, every time we think about these items, remember, first thing we want to consider is what does this number contain? What does that number contain? We're going to be using the equity method in this case to get to that number. Then we also want to be considering within the equity method, once we know that we are using the equity method, we also want to know, was there a difference between any of the assets and liabilities, book value versus fair value, because that's going to affect, how this number came about with regards to the equity method and the purchase price, and whether or not there is goodwill involved. So we want to know those items. Then, once we know the equity method, we also want to know, is the equity method going to be adjusted for anything such as depreciation for company S having depreciation because the book value being different than the fair value, would that, and how did P account for that using the equity method? In other words, if I look at the net income for S, does P's income from S, which would be reflected here, showing the percentage of income owed to P, does it reflect any kind of changes with regards to like expenses like depreciation? In this case, it does, because you would think that this would be 70,000 here, but it's not. It's 67, which leads you to believe since P owns 100%, there must be something else involved. In other words, P adjusted S's net income for an adjustment that resulting from the consolidation, which is going to be the depreciation. Okay, so let's go back to this. We're going to say the book value for S is 143. Where did we get that number? Normally, we would get that number from the balance sheet of S at the point of consolidation 1 year ago. In a book problem, they gave us S's numbers over here, but S's numbers as of 1 year later. In other words, this is as of December, purchase took place in January. So we know that then the common stock here, nothing has changed, and the retained earnings, nothing has changed. Why? Because net income hasn't rolled into it. So book problems like to do this like 1 year out kind of thing, because then you can recalculate the entire equity method, and you can basically get the book value of the net income of assets minus liabilities as of the point in time with the trial balance as of the point in time of the purchase. So the 44,000 and the 99,000 is the 143,000. Now, normally we would then add to that basically any kind of adjustment we had for the fair value of the assets and liabilities, which in this case would be the building and equipment. But we don't have that now. We happen to have instead the end number, the goodwill. So what we're going to say is we're going to say, all right, well, goodwill. And notice I'm kind of recalculating, so I'm basically reformatting the equation, and then I'll show you the normal equation, how I would think about this oftentimes as well. So we've got the book value and then the goodwill. We're going to have a subtotal. So this is the 167,000. So we have the book value, and we know that there was some intangible asset as part of the purchase price. Now, if that was it, meaning if we didn't revalue the book value and we had goodwill on the books, then this number would be the same as the purchase price. If it's not the same as the purchase price, then we must have revalued something over here. And we're saying that the purchase price was 200,000, and therefore something was revalued. That revaluation, as it says here, is due to the depreciable assets. So that means that the difference, the 200,000 minus the 167, is the depreciable assets. Now, how you probably want to think about this normally is if this doesn't like ring true for you at the first glance, what you'd want to do is just like you would do with a cost of goods sold calculation, just say, all right, they gave me that data, so I'm just going to do my normal formula, which would be the book value plus the increase in the fair value of the depreciable assets, or the unknown, the change in something on the assets and the liabilities. That would be the unknown, right? That would give us basically the fair value of the assets minus the liabilities of S at the point of purchase, and then you would compare that to the purchase price, which was the 200, and that would give you the goodwill. So then if you write it this way, then you can write it out algebraically with this being X, the unknown, and then you can reformat it to basically this if you want to write it, in an algebraic format to figure that out, or if you just want to basically double check it with this formula. This is the formula that I would basically memorize. I wouldn't memorize, in other words, this formula up top. I would simply use algebra to then plug in the unknown with this formula. Okay, so then once we have that set up, then we can think about the equity method. So now the question is, how did we get to this number here? How did that number come about? Well, they're going to be using the equity method. That's basically the assumption, unless they say otherwise. So they could use the cost method, but the equity method would typically be the case. What you want to know then, once you say, okay, they use the equity method, did they account for the fact, now that I know that there's going to be a difference in the depreciable assets, did they account for that depreciation adjustment here in the current year, basically? So in other words, this 70,000, and you could check that by saying this 70,000 is not the same as this 67,000. Is that difference the depreciation of the added assets for the current year? Well, let's check it out. If I pull out the trusty calculator here, we're going to say that the depreciation difference we said was 33,000. That's for the difference in the depreciable assets divided by 11, and that would be 3,000, right? And that's going to be the difference between that 67 and 70. So then we would assume that what was the journal entries that took place. Now, this is 1 year later, so we can do the full calculation. I can say, all right, Well, they put it on the books where they debit the investment and they credited cash. That's what P did. And then P said that they're going to, let's put the full amount of the net income. So S made net income. So P records its portion, increasing the investment and increasing the income. Now it's at 67. I just increased it by 70. Then we recorded the dividends of the 2024. That increased the dividend, the cash to P, and the dividend and the investment income goes down. The investment in S goes down, the asset account up top. Then we're going to decrease by the calculation that P knows about because of the consolidation, that being the added depreciation, which is going to have an effect on net income. So it's going to say decreasing the net income, getting us down to that 67,000, and the other side going to the investment in S. So therefore, the investment in S is going to be this, and this, and this, and this. And that'll give us the 243. It's only been 1 year out, so we can calculate the entire thing and see how that's coming about. And that'll help us to basically think about how we reverse things now. So then we're going to say, all right, now let's do our reversing or eliminating entries. So our eliminating entries. Reversing entries are technically a name for another thing, right? So adjusting entries, reversing entries. Now we have consolidation or elimination entries. Okay, so we know that we need to eliminate this account here. So I usually start with that, even though I'm going to break this out instead of one long journal entry, which I think is useful to use sometimes. I'm going to break it out into multiple journal entries so we could see, different ways that we can approach this. So I'm still going to say that I know that account's affected. I'm going to use it as the plug, even though it's a credit up top, and I want you to imagine that this number has not yet been posted, right? That's going to be the plug number of our transaction. Then I'm going to remove all of the equity. So I'm going to say, all right, I'm going to do whatever I need to do to that account, and I'm going to remove the equity. So I'm going to remove the common stock. So common stock, we're going to debit the common stock for the 44 because that's what's in it for S. So there we have the 292 plus the 44 gives us the 336 minus the 44 brings us back to P's portion, the 292. We'll do the same thing for the retained earnings. So we're going to debit it for the 99. So we have the 347 plus the 99 is the 446. Then we're going to be removing the 99 to get us back to the 347. Then we're going to do the same thing for the dividends, except for the dividends being a debit. Therefore, we will credit it to make it go down. Dividends. So then we have the 64 plus the 24 gives us the 88. Then we remove the 24, bringing us back to the 64. So now we have removed basically the equity section up top for S, and now we are in essence going to remove the equity section, the income statement accounts down below, but we're not going to remove each line item. We're typically going to remove this number, right? The 67,000 reflected on P's books. However, the 67,000 here does not tie out to what's on S's net income because it's different by the net income that's going to be recorded during our consolidation when we add the 50 or whatever the increase in the, I think it was 33,000 to the machinery and equipment that we're going to have to depreciate in the current year. So I'm going to put the entire amount on this time. I'm going to say I want to account for the full equity section for S. So I'm going to take this entire amount, even though it doesn't do exactly what I want. It achieves my goal that I can picture, that we basically took care of the full equity kind of section, in that we took care of these accounts now, and then the 70,000 representing basically these accounts. All right, so then that means that this account up top is the plug. So this account, how did I get that 189? It's the plug. So the debits minus the credits now add up to that 189. That's not what I want it to be. I want it to be at the end of the day, making this go down to 0. I want it to be that 243. So that's not perfect yet, but that's okay. We took the common stock. We're going to say that now the income from S is being credited, and that didn't go to what we wanted, but I know exactly what that difference is. That's due to the depreciation. That's off by 1 year's worth of the depreciation. So it did what we wanted here because these three numbers now tie out to basically P's numbers, is what we expected. We removed, in other words, the S's portion, and then this wasn't perfect, but I see exactly what that difference is, and this one isn't perfect. That's kind of our plug number that we're going to be used as we consolidate these together. All right, next step. we're going to say, all right, I know that there's depreciation that's going to be recorded, which you'll recall we said that the depreciable assets were higher at the point of purchase by 33,000. If we divide that by 11, which is a simplification like a straight line method for that increase, we're going to have to do an adjustment for that portion each year for the depreciation now. Now, I'm going to do it this time a little bit different than we did last time. I'm going to say we need to debit this year the depreciation of the 3,000. Now, notice, if we do this for multiple years, the accumulated depreciation we'll have to record the accumulated depreciation each year, accumulating, because S isn't going to be recording these items, because S is not going to be recording this item at fair value. They're going to keep recording it at the book value, but we're just recording the current period's portion, which there's only been 1 year at this point in time. So we're going to debit the 3,000 here. And then I'm just going to do the normal thing that you would think now, which is credit accumulated depreciation. In other words, I need to increase 3,000 of depreciation expense, and you would think the other side, a normal adjusting entry, would be a credit to accumulated depreciation. So let's do that. That's what you would normally think. That will increase the accumulated depreciation. However, that still leaves us with this 3,000 here, right? That 3,000 is something we still need to take care of. That's what we credited last time in our last, basically, example. So we're just doing a little different kind of sum up of how this will work. Then I'm going to put in the machinery and equipment of the 33,000. That's going to be representing this 33,000. It was 33,000 higher at the point in time of the purchase. So we're going to increase the machinery and equipment by that 33,000. And then we're going to be increasing the goodwill. And you'll recall we calculated the goodwill to be the 24,000 that was given to us. Typically we would calculate it though. So that's going to be the 24,000 which we calculated. That's going to go on the books here at the 24,000. And then what we're going to do is just remove what we know needs to be removed. We know that income right there from S needs to be 0. So it's on the books as a debit now. So then we're going to credit it to make it go down to 0. And then the difference is going to be the investment in S, which is going to be that 54,000, which we're going to remove now. So there's this last kind of piece, or this last journal entry, you can think of it as kind of the plug. This is where we're hoping everything should basically work out. So in other words, this first journal entry we did was to remove basically the equity section. So all of these accounts were represented here, all of the equity accounts, and basically net income, which represents all of these accounts. And then we did this transaction, in essence, recording the added depreciation that is going to be a result of us increasing the building and the depreciation for the current year. Now, there's only been 1 year, so we don't have any prior years since the point of time of purchase. But if we did, then this number would just be for the current year. And then this one's kind of like everything else that we have to deal with. What is everything else we had to deal with? Well, we know that the building and the machinery was higher, so we got to increase the building and the machinery, and the other side of that, of course, went into the investment account when we did the purchase. We know that goodwill was on the books as part of the original purchase, and the other side of that was in the investment account when we did the original purchase. And then we know that this account needs to go to 0, right? We know that this account, because we already basically recorded, the net income using the equity method here, resulting in this, this $3,000 difference. I rolled it back a second. This $3,000 difference, and then when we recorded that, we know that one needed to go to 0. So, and then this one up here, of course, we know that needs to go to 0. So at the end of the day, we would expect that one to go to 0 as well. So this one kind of finishes off the tasks that we would think. Now, this is the major consolidation components here, these journal entries we're looking at up top. So the check figures that you would then want to be considering, you're going to say, all right, did this one go down to 0? It did. The investment from S should go down to 0. Did we eliminate these? We did, meaning these equity accounts basically tie out to the parent's equity accounts at this point, given the conditions we have for this consolidation. And did this account go down to 0? We can't have that. That shouldn't have an account there. That went down to 0. So those are some of the things that you can kind of check to do this. Now remember, you can format these 3 entries in different ways. I think it's actually easier to just do this one journal entry sometimes, which means this account, I would just start off saying, hey, look, I just got to take off the entire 243. I know that. I know that these got to be eliminated, so I know that, boom, 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 I just remove those. I know that this has to be removed for whatever's in it, the 67,000. So instead of doing a two-step method, you can just remove, the entire amount. And then I know the difference is going to be the fact that we have the depreciation for the current period, and the accumulated depreciation, the building, and the goodwill. And so, you could think about it kind of as one long journal entry, and it'll work out that way as well. And you could group this in different formats as well. So whatever makes the most sense to you, I would work it in a few different ways, and I would do it in Excel so it'll be easier to do in a few different ways. Then we had the intercompany transactions. So for example, if I looked at P's books, we're going to say if I looked at the subsidiary ledger for the accounts receivable for P, we see that S owed them money, $25,000 it looks like. And then if we looked at S's subsidiary ledger for the accounts payable, we would say there would be a vendor, which would be P, so S owes P the $25,000. That means that assets, when we consolidate, assets and liabilities will be overstated, netting out in the equity section, but we need to remove or decrease them both. So the accounts payable then going down with a debit, and then we're going to credit the accounts receivable then going down with a debit. Then we have the depreciation. So you'll recall that standard journal entry we've seen in the past where we have the building and the accumulated depreciation. The accumulated depreciation at the point in time of purchase a year ago was $56,000. Now, normally we would know that because we would have the information, but if there's a book problem that's only 1 year out, they may have like a tricky little calculation for you to figure that out. And that little tricky calculation would be, okay, I know that accumulated depreciation is $65,000 minus the depreciation expense $13,000. And that'll give us the 52. That's what it must have been on the books for S at the point in time the purchase happened, because that only happened a year ago. And so we know that. And notice I don't need to consider the other 3,000 or the increase in the value, because I'm only looking at S's books, and S isn't, taking into consideration the increase to the fair value and whatnot. So that's going to be the 52,000, and we're going to net that together. In other words, we're not going to be reporting as of the point in time of purchase the cost and the accumulated depreciation that you would have to net out, but instead putting the net simply in the building and machinery account. So we will then remove the accumulated depreciation for it, and then the building and the equipment will go down to relate to that as well. So there's going to be your information, and again, you want to check some of those core, the core accounts here that we looked at just a little while ago. I won't go over them again, but these core transactions, rework these core transactions a few times. Highly recommend doing a few of these problems in Excel, because if you do these in Excel, then you can basically go to accounts like this and see what it consists of. You can go to accounts like this and tie them out to basically the equity method. You can look at this number and basically recalculate it much more easily, and it's just good to practice in Excel. And of course, it's good times to do that as well. So I highly recommend working through these in Excel a few times.